Every dollar in your wallet represents someone else's debt. When you hold cash, you're holding a promise that someone, somewhere, owes money they may never be able to repay. This isn't metaphorical, it's the literal foundation of our monetary system. Think about the last time you bought coffee with a $20 bill. You handed over what you believed was money, but what you actually transferred was a piece of paper representing a government IOU. That barista didn't receive stored value. They received a promise backed by our collective faith in an impossible mathematical equation. Here's what should grab our attention. Every single dollar circulating in our economy entered existence the moment someone, somewhere, signed a promissory note. Your mortgage payment, your credit card purchase, even the cash in your pocket. All of it represents borrowed money that someone promised to pay back with interest. But here's where it gets interesting. Most Americans have no idea that this system was deliberately engineered just over a century ago through what might be the most consequential piece of legislation in our nation's financial history. Picture this scene from December 1913. While most of Congress had already left Washington for Christmas break, a small group of lawmakers gathered for an emergency session. They were about to pass the Federal Reserve Act, a bill that would fundamentally transform what money actually means in America. The man leading this charge was Representative Carter Glass from Virginia, and his story reveals everything about how we arrived at our current predicament. Glass had spent years warning against the dangers of debt-based currency. He understood that when banks create money by lending deposits that don't actually exist, they're essentially counterfeiting currency through legal loopholes. Yet by December 1913, this same man was arguing passionately for a system that would institutionalize exactly what he had previously opposed. What changed Carter Glass's mind? The promise of elastic currency, a deliberately vague term that would allow our money supply to expand and contract based on economic needs. But elastic currency meant something far more revolutionary than anyone publicly admitted. Under the new Federal Reserve System, banks could now create money from nothing by issuing loans against deposits that existed only as bookkeeping entries. When you apply for a mortgage today, the bank doesn't hand you existing money from their vault. Instead, they create new money by typing numbers into a computer, then expect you to pay back that newly created money plus interest using dollars that already existed before your loan. Let's walk through exactly how this works in your daily life. You decide to buy a house and need a $300,000 mortgage. You visit the bank, sign the paperwork, and receive what appears to be a loan of existing money. But here's the revelation that changes everything. The bank just created that $300,000 out of thin air the moment you signed your promissory note. Your signature didn't authorize the transfer of money that was sitting in some vault waiting for borrowers. Your signature literally brought new money into existence. The bank's only requirement was to hold about $30,000 in actual reserves, 10% of the loan amount. The other $270,000 created from nothing except your promise to repay. This means something extraordinary about our monetary system. When you make your monthly mortgage payment, you're not paying back money that previously existed. You're paying back money that your own signature created, plus interest on money that never existed until you promised to repay it. The Federal Reserve Act of 1913 made this alchemy legal by introducing the concept of elastic currency. This innocent-sounding phrase was actually a constitutional workaround. Our Constitution requires that money be backed by something tangible, gold, silver, or other real assets. But elastic currency allowed banks to back new money with nothing more than borrowers' promises to repay. Think about what this means for every transaction in our economy. That grocery store accepting your debit card payment isn't receiving money backed by gold reserves or stored labor. They're receiving digital representations of someone else's debt obligations. The cash register rings up your purchase using currency that exists only because millions of Americans promise to repay loans they may never be able to fully satisfy. Here's where the mathematical impossibility becomes clear. Since all money enters our system as interest-bearing debt, there's always more total debt than there is money to repay it. If every loan in America was paid back tomorrow, our entire money supply would disappear, leaving us with no currency for basic transactions. The banks understood this mathematical trap from the beginning. Federal Reserve documents from 1913 acknowledge that elastic currency creates a system requiring perpetual debt expansion. They knew that once money becomes debt, the economy must grow exponentially or face systematic collapse when debt service exceeds available currency. But the architects of this system knew something that would terrify most citizens. They had created a monetary framework that makes financial independence mathematically impossible for the majority of participants. Every dollar you save represents someone else's unpaid debt. Every debt you pay off removes money from circulation, requiring someone else to borrow new money into existence to maintain economic flow. What happened next would transform every transaction in America into an act of debt creation, turning our entire population into unwitting participants in a system designed to ensure that debt could never be fully repaid. But creating money from debt was just the beginning. The real genius was making everyone addicted to the process, from individual citizens to entire nations, creating a system where freedom from debt became not just difficult, but mathematically impossible. Meet Sarah, a recent college graduate from Ohio. Last month, she received her student loan disbursement, $45,000 deposited directly into her bank account. What Sarah doesn't realize is that her signature on that loan agreement literally created the money she received. The bank didn't transfer existing funds from some education account. They created new currency from nothing, backed only by Sarah's promise to spend the next 20 years paying it back. Here's what makes Sarah's situation particularly revealing about our debt money system. The moment she signed her promissory note, 45,000 new dollars entered our economy's money supply. But here's the mathematical trap. Sarah must now pay back that original 45,000 plus interest using dollars that already existed before her loan was created. Think about this scenario. Sarah's loan created new money, but her repayment must come from the existing money supply. This means that for Sarah to successfully repay her debt, someone else in our economy must go deeper into debt to create the additional currency needed for her interest payments. Her financial freedom requires someone else's financial bondage. This isn't theoretical economics. It's the daily reality of how our monetary system functions. Every student loan, every credit card balance, every corporate bond creates new money when issued, but requires repayment from existing currency plus interest that was never created in the first place. The mathematics become even more disturbing when you scale this up to entire cities and states. Take Detroit, a city that declared bankruptcy in 2013 despite decades of attempting fiscal responsibility. According to municipal bond documents, Detroit's financial collapse wasn't caused by mismanagement or corruption. It was caused by the mathematical impossibility of servicing debt in a system where all money is borrowed into existence. Detroit's municipal bonds created new money when they were issued in the 1980s and 1990s. But by 2010, the city needed to repay those bonds using tax revenue collected in dollars that competed with every other debt obligation in our economy. As more entities borrowed money into existence, fewer dollars remained available for Detroit's debt service, making default inevitable regardless of the city's fiscal discipline. The same pattern destroyed Stockton, California, and Jefferson County, Alabama. These weren't failures of local government. They were predictable outcomes of a monetary system that creates currency through debt but requires repayment from a money supply that's always smaller than the total debt outstanding. But here's where the addiction becomes most obvious. Rather than questioning why debt-based currency creates these impossible scenarios, we've doubled down on the system. Cities that can't repay their bonds issue new bonds to service old debt. Students who can't repay their loans take out additional loans to cover interest payments. Nations that can't service their debt borrow more money to avoid default. Consider how this played out in corporate America. General Electric, once synonymous with American manufacturing innovation, provides the perfect case study. In the 1980s, GE discovered something revolutionary. Creating debt was more profitable than creating products. GE Capital, the company's financial arm, began generating higher returns by lending money into existence than GE's manufacturing divisions could produce by making actual goods. By 2007, GE Capital was contributing more than half of the company's total profits, not by building better light bulbs or jet engines, but by participating in the debt money creation process. Here's what happened. Instead of using their capital to expand manufacturing, GE used their balance sheet to create loans for everything from aircraft financing to credit cards. Every loan created new money backed by borrowers' promises to repay, and generating immediate profits for GE, while adding to the total debt burden that makes economic stability impossible. The transformation was so complete that by 2008, GE Capital had become one of the largest financial institutions in America. The company that once symbolized American industrial might had evolved into a debt creation machine because our monetary system rewards debt production more than actual production. This corporate evolution reveals something crucial about how debt money changes economic incentives. When currency creation becomes more profitable than goods creation, entire industries abandon productive activities to focus on debt generation. Banks stopped being intermediaries between savers and borrowers and became currency manufacturers. Corporations stopped being producers and became financial institutions. Even universities stopped being educators and became debt processing centers that happened to offer classes. Now, let's examine how this system creates international dependency. The International Monetary Fund and World Bank have exported America's debt money model globally, but with a vicious twist. Developing nations must borrow dollars to participate in international trade, but they can only obtain those dollars by going into debt to institutions that create currency from nothing. Here's how the international debt colonization works. A country like Nigeria needs dollars to buy oil equipment or medical supplies from American companies. But Nigeria can't create dollars. Only the Federal Reserve System can do that. So Nigeria must borrow dollars into existence through IMF loans, then repay those borrowed dollars plus interest using revenue from their own natural resources. The mathematical impossibility becomes obvious when you consider that every dollar Nigeria borrows must eventually be repaid from the same limited pool of international dollars, as more nations compete for the same finite supply of existing currency to service their dollar-denominated debts. Some countries must inevitably default, regardless of their resource wealth or fiscal discipline. This is exactly what happened to Argentina in 2001, Russia in 1998, and dozens of other nations that found themselves trapped in dollar debt cycles they couldn't mathematically escape. These weren't failures of economic policy. They were predictable consequences of a global monetary system that creates currency through debt but demands repayment from existing currency supplies. The system has become so pervasive that even our personal financial decisions reflect this debt money addiction. Americans now carry average credit card balances exceeding $6,000, not because we're financially irresponsible, but because our economic system requires constant debt creation to maintain currency circulation. Every time you use a credit card, you're participating in currency creation. The bank doesn't transfer existing money to the merchant. They create new money backed by your promise to repay. Your purchase literally increases the money supply, while your monthly payment reduces it. This means our economy requires millions of Americans to maintain permanent credit card debt to prevent the money supply from contracting. Yet this system of perpetual debt carries within it the seeds of its own destruction. The mathematics of compound interest on an exponentially growing debt base creates scenarios that no amount of financial engineering can solve. Here's the mathematical reality that central bankers desperately hope you never understand. When currency requires interest payments exceeding the money supply's growth rate, collapse becomes not just possible, but mathematically inevitable. Let's walk through the numbers that reveal why our debt-based currency system contains a fatal flaw that no financial engineering can fix. Our national debt currently exceeds $33 trillion. The interest payments on that debt require approximately $1 trillion annually. But here's the problem. That $1 trillion in interest payments must come from the existing money supply, while the debt principal continues growing through compound interest. Pop quiz. If our entire money supply totals roughly $21 trillion and our debt grows by compound interest while requiring annual payments from existing currency, how long before the mathematics become impossible? The answer reveals why every debt-based currency system in history has eventually collapsed. Consider what compound interest does to impossible equations. At just 3% annual interest, debt doubles every 23 years. This means our $33 trillion national debt becomes $66 trillion by 2046, then $132 trillion by 2069. Meanwhile, our ability to service that debt depends on an economy that must somehow generate enough existing currency to make exponentially growing interest payments. The mathematical impossibility becomes clear when you realize that servicing debt requires currency that already exists, while debt growth creates obligations that exceed the total money supply. Eventually, the interest payments alone require more money than exists in circulation. This isn't theoretical mathematics, it's exactly what destroyed the Weimar Republic in Germany during the 1920s. German war reparations created debt obligations that exceeded the nation's ability to generate currency through productive activity. The government's response was to print more money, but since the debt was denominated in gold-backed currency, printing paper money only accelerated the collapse. By 1923, German workers needed wheelbarrows full of cash to buy bread, not because of hyperinflation, but because the mathematical relationship between debt service and money supply had reached impossible proportions. The Weimar Republic's collapse wasn't caused by poor economic policy. It was caused by the mathematical impossibility of servicing exponentially growing debt with linear currency creation. Zimbabwe repeated this exact pattern in the 2000s when government debt service began requiring more currency than the economy could generate through productive activity. President Mugabe's solution was to print more money, creating the famous $100 trillion bills that couldn't buy a loaf of bread. But the printing wasn't the cause of collapse. It was a desperate response to mathematical impossibility. Venezuela provides a contemporary example of debt currency mathematics reaching breaking point. Despite possessing the world's largest proven oil reserves, Venezuela's currency collapsed because debt service obligations exceeded the economy's to generate sufficient currency through petroleum sales. The believers' hyperinflation wasn't caused by socialism or corruption. It was caused by debt mathematics that made currency stability impossible regardless of political system. Here's what should terrify anyone paying attention. The United States is approaching the same mathematical inflection point that destroyed these other nations. Our debt service costs are consuming an ever-increasing percentage of tax revenue, while our debt principal grows exponentially through compound interest. Federal Reserve Chairman Jerome Powell inadvertently revealed the system's mathematical fragility during the 2008 financial crisis. When major banks faced insolvency due to debt obligations exceeding available currency, the Fed's response was unprecedented. They created trillions of new dollars through quantitative easing to prevent systemic collapse. But here's what quantitative easing actually accomplished. Rather than solving the debt currency mathematical problem, it temporarily delayed the inevitable reckoning by inflating the money supply to match debt obligations. The Fed literally proved that our monetary system requires constant currency creation to prevent mathematical collapse. Think about what this means for your personal financial future. The same mathematical principles that destroyed other debt currency systems are operating in our economy right now. Your savings account contains currency whose value depends on the government's ability to service exponentially growing debt using existing money supplies. The Fed's own documents acknowledge this mathematical trap. According to Federal Reserve research, debt-based currency systems require perpetual economic growth to remain mathematically viable. But perpetual exponential growth on a finite planet creates physical impossibilities that no monetary policy can overcome. Now, here's where the mathematics become truly frightening. Bitcoin and other cryptocurrencies represent an existential threat to debt-based currency because they eliminate the need for debt money creation entirely. Bitcoin's fixed supply cap of 21 million coins makes debt-based inflation impossible, threatening the fundamental mechanism that keeps our current system operating. Central banks worldwide are responding to this threat by developing their own digital currencies, but with a crucial difference. Central bank digital currencies will maintain the debt creation mechanism while providing governments unprecedented control over currency circulation. Rather than fixing the mathematical impossibility, CBDCs represent an attempt to maintain debt-based currency through digital surveillance and control. Meanwhile, major economies are quietly preparing for currency system replacement by accumulating physical gold at unprecedented rates. China, Russia, and India have increased their gold reserves dramatically over the past decade, not because they distrust paper currency, but because they understand the mathematical inevitability of debt currency collapse. The Bank for International Settlements recently acknowledged what insiders have known for decades. Debt-based currency systems contain mathematical instabilities that make long-term stability impossible. Their proposed solution isn't to eliminate debt-based currency, but to manage its collapse through controlled resets that preserve the existing power structure. Lebanon provides a real-time case study of what debt currency collapse looks like in the modern era. Lebanese banks froze customer accounts when debt service obligations exceeded available currency, effectively demonstrating that depositor funds exist only as digital entries backed by impossible mathematics. Lebanese citizens discovered that their bank balances weren't backed by stored value, but by debt obligations that the banking system couldn't mathematically fulfill. Their life savings disappeared not through theft or mismanagement, but through the mathematical inevitability of debt currency systems reaching their computational limits. Here's what the mathematical certainty means for our future. The same exponential debt growth that destroyed Germany, Zimbabwe, Venezuela, and Lebanon is operating in our economy right now. The only question isn't whether collapse will occur, but whether we'll recognize the warning signs in time to protect ourselves. The dollar bills in your wallet still represent someone else's debt, but now you understand why that debt can never be fully repaid. We've created a monetary system based on mathematical impossibility, disguised as sophisticated financial engineering. Every transaction you make participates in a system designed to ensure that debt grows faster than our ability to service it. The mathematical certainty isn't a prediction. It's already encoded into the compound interest calculations that govern our monetary system. The only remaining question is whether we'll choose to understand these mathematics before they choose our economic future for us.